discussed was this concept of spot rate. What is a spot rate? It's related to the settlement of the trade. Like even in stock market, if you want to buy a stock, the stock won't come to your account, demat account today, and your rupee need not be debited today. I mean, it will be debited generally, for a user like us, but for a member, generally it's not. So each market has a convention as to when the actual bank transfers will happen. So in case of a spot rate, the rate that you're seeing in the current screens, any screen that you see, the 79.0102, this rate is actually a spot rate, right? Spot rate is for 2 business days settlement from the trade date. So today, if I buy a currency or sell a currency against another currency, let's example of dollar rupee. So if I buy dollars against rupees, the actual dollar settlement against my rupee amount will happen 2 business days from today, which means 2 days from today, such that that day is a working day in both India, Mumbai and New York. Right? Because it has to be, settlement has to happen on a bank working day. So the spot date is basically 2 business days. In the market convention, it is called T+2 settlement, right? T+2. T+2 meaning 2 business days from today is a settlement date, right? This is something we discussed last time. I'm just repeating it here. And this is called the spot date. Now, instead, there are situations where the particular entity might need dollars today itself or tomorrow, or instead of 2 business days. Think of a day after tomorrow. For example, today is Thursday. So actually the spot date will be what? Tomorrow is Friday, but Saturday, Sunday are holidays. So Monday is not a market holiday either in New York or in Mumbai. So Monday becomes the spot date. Now, what if I want to actually settle my accounts tomorrow? That means the bank transfers have to happen tomorrow. That is T+1, right? That settlement is what is called a TOM settlement or TOM date. And whereas if I want to settle it today itself, it is called a cash date. Cash date meaning today itself. The settlement, the actual account transfer have to happen today itself. So the point here is the spot date is basically the default date that you see in the market. But if you want the dollars to be settled today or tomorrow, then there are rates available, and these rates are called spot. So spot rate is for spot date, then there is a TOM rate, and there is a cash rate. So these rates are available in the market. Now we'll discuss as to how they are arrived at, and in general, what is the relationship between interest rates and FX later. But this is the terminology you have to be aware of. So the concept of how markets are quoting the fixed rates, then the concept of bid offer, and finally the concept of spot rate, TOM rate, and the cash rate. These 3 are what we discussed last time. Again, I'm repeating it for everybody's benefit. Okay, so this is what it is. Now, let us now get into the nuances and nitty-gritty of these cash, TOM, and spot rates, because this will tie into how FX markets are linked to interest rate markets in general. Because at the end of the day, FX market, for that matter, any global market is not really related. Rather, it is not, it's not really related to any one asset class. Markets are all interlinked with each other. So this will make you understand how they are linked. And why spot date, by the way, just this is a question here. Why spot date? Why can't it be today itself, right? The reason is internationally, right, for that matter, even in a domestic market, you need time to settle, right? For example, at 5 o'clock in the 4:30 in the evening, 4 o'clock in the evening, you do a trade. You can't expect that account settlement to happen today, right? Because there is a working time for settlement to happen. So there is a time lag always. And with FX market in general, it's a 24-hour market across the globe. So the Japanese accounts, Japanese yen settlement account and New York, US, the time difference is significant, close to 15, 16 hours. So if you do a trade in one time zone, you need some time for the banks to work and for the settlement mechanism to work across international markets to settle. So there is a time lag always. So for ease of convention, for ease of bank transfers and for facilitation of activity, there is a time lag, and the time lag is 2 business days, so that there is enough time for settlements to happen. That is this is with the understanding that any trade I'm going to do today will have a 2-day settlement period. That's how the markets evolved over time. That's why this is 2+2 business day settlement. Now, obviously, there are choices. I mean, if you want today itself settlement, then there are some restrictions. Obviously, if I do it in the morning, I can expect a settlement in my account by afternoon. But if I do a trade in the evening, I can't expect the account settlement happen today. So the institutions, the banks will not quote you the settlement today by evening. Very difficult sometimes to get that rate. So settlement is basically to do with ease of doing business, ease of doing the settlement. So, and also people have to plan for their funds, how many funds are to be transferred in each currency. So there should be some time gap, right? So that is the reason why this market starts as spot being the default, and cash rate, each currency has a timing. For example, if you are in India and you want to do dollar to yen trade, JPY has a time, 2.5 hours of time difference, and they're ahead of us. So it's very difficult to generate JPY to settle the Japanese yen to settle the account today itself. So early morning or maybe 9:30, 10 o'clock, that settlement can happen. But by the time you go and want to do a settlement you want to do a trade where you want to settle yen today against dollars, not possible today in the evening, because the JPY Japanese banks are closed. The yen transactions are over in that sense. So there's a time. Similarly, in the local currency like dollar to rupee, because rupee is a domestic currency, banks will have enough rupee funds to settle. So they are okay settling even a bit late. But dollars are a foreign currency. So dollar funds, they have to plan. It's not just one trade, right? There are thousands or millions of trades happening. So at a bank level, they have to plan their funds. So there's a time lag, time limit. You can't just do any trade for settlement value cash or value today. But spot you can do up to the market timings. For example, India market opens at 9 o'clock, 9:30 and 9 o'clock and close at 5 o'clock. That is a standard market timing. So you can do it anytime, not a problem, because settlement is T+2, right? Not a problem. Settlement can happen 2 days later. So that is the reason why markets evolved like this. Okay. So now let us understand how are these rates calculated, right? The reason why I'm talking about this concept is to make you understand the concept of interest rate parity, right? Covered interest parity, as people call it. It's an important concept in FX markets, and also to appreciate the concept of a forward rate and a future rate, because this concept will also be important when you get into other markets like equity futures, or for that matter, any future or a forward contract. How is it linked to the spot rate? For you to understand that, you need to understand the concept of interest rate and how they are related to different markets, right? That is the agenda for the next few minutes now. Okay, fine. Now let us understand how this spot rate, term rate, and cash rate are linked to each other. How are they linked to each other? Okay. Now, before we do that, I will take an example of USD INR. USD INR meaning dollar to rupee. Right? Now, let us say, for simplicity's sake, I'm not going into bid offers right now. See, bid offers are important. We'll come to that a bit later. But let us assume there is a single rate, both for buying and selling, just for understanding purposes, completeness sake. We'll do bid offer a bit later. Okay, let's say dollar to rupee is 79, right? 79 rupees is my dollar to rupee code, which means $1 is equal to 79 rupees. Now, this is the spot rate. Now, instead of spot rate, that means instead of spot settlement, I want the rate from the market to settle tomorrow. Okay. Instead of 2 days, I want to settle in 1 day. Okay. Now, let us assume that I want to, it doesn't matter you're buying dollars or selling dollars. They're not that important. Let us say I want to buy dollars, right? If I want to buy dollars, now look at the situation here. I want to buy US dollars against rupees for value or tomorrow, right? This is what I want to do. Now, this is what I want to do. Now, I will also give you this data. What is the data? That the USD interest rate meaning that assuming I meaning, let's say I'm also part of the market. I'm also a trader. I'm also a bank. Assuming that I can borrow dollars or borrow rupees, lend dollars, lend rupees. I can freely do both of them. Not a problem. I'm assuming that. Now, USD interest rate, let's say USD interest rate, meaning for one day, in the international markets, in domestic market, interbank market, the interest rates are quoted for different tenors. Like your FD rates, you have interest rates quoted for different tenors, starting from one day overnight, as we call it, overnight interest rate, right? 1 day interest rate or 2 days interest rate. They're all quoted in the market, right? They're depot rates, right? So in the interbank market, these rates are available. So I'm just taking the USD interest rate that is available right now. Let's say it's at 1%, right now, and INR rate, interest rate in the market for 1 day or 2 days is, in this example, let's say 6%, right? Now, these are the data points I've given you. Now, let us logically understand how the fact that I want a settlement for value tomorrow is going to impact the person who wants a settlement, either buying dollars or selling dollars, right? Let us understand this in a logical way so that you can appreciate how interest rates are linked to FX rates, market rather. Now, if I want to buy dollars for T+2 settlement, right? So this today, right? Then this is T+1 and this is T+2. Now, this is USD and this is INR. I'm making a simple table here. Now, let's say I will take an example of $1, just for simplicity's sake, just one USD against how much? 79 rupees, right? This is our quotation. Now, T+2 here, if I want to buy $1, what will happen? At the end of 2 days from now, I'm going to get $1 into my dollar account, and I'm going to pay how much? Minus 79. I'm writing minus here to show that I'm paying out. I'm going to pay. My account is debited 79 rupees. This is what is going to happen at the end of 2 days from now. Now, instead, I want to do this trade wherein I want to buy that $1 not 2 days from now, but tomorrow, right? Tomorrow, T+1, not T+2. So what will I do? In that case, what will happen? My account, instead of actually going to be debited, rather credited, my dollar account, instead of getting $1 2 days from now, I will get 1 day from now. That means tomorrow, basically. And I have to pay rupees tomorrow itself, instead of day after tomorrow. Right? Now, the question is this. As a buyer of dollars, what is my gain in this example? In this scenario, the gain is that instead of 2 days from now, I'm actually getting the dollar 1 day from now. In other words, I'm getting dollars 1 day in advance, right? I'm actually getting my dollars instead of T+2, I'm getting T+1. So 1 day I'm getting advance, which means for that 1 day, I can actually put that dollar amount, that $1 into a deposit and generate interest on that. How much interest? 1% per annum, right? That is the amount. So 1 by 365 roughly, that much interest I can generate by actually getting the dollar 1 day in advance. That's my benefit. So I gain 1 day interest basically on the USD side. But then the problem is in the spot rate, I'm actually paying rupees at the end of 2 days from now, which means I have my rupees with me. Instead of paying the rupee today or tomorrow, I'm paying 2 days from now. But in T+1 settlement, I have to pay the same rupees. How much? 1 day from now, tomorrow itself, which means I'm foregoing interest, or either I'm foregoing interest or if I'm borrowing somewhere to pay this, I have to pay extra cost. Whatever it is, I'm foregoing interest. I'm foregoing 1 day interest on the rupee side. So the point here is instead of actually paying 2 days later, I'm to pay 1 day later. So I'm foregoing 1 day interest on rupees. So the problem is the rupee, both the interest rates are not the same. The interest rates are actually different. So rupee rate is 6% and dollar rate is 1%. So as a buyer of dollar, I am losing out 6% interest on my rupee amount, but I'm only getting 1% interest extra on my dollar account. So the question is, why would anybody want to do it like this? If the market is giving me the same 79 rupees for tomorrow also, instead of 79 for 2 days later, if it gives me the same 79 for tomorrow, obviously one of the counterparties is gaining, because that counterparty is generating interest, extra interest of 5% for that 1 day, right? Because rupees rate is 6%, dollar rate is 1%, that extra 5% is being generated for 1 day. Therefore, the seller obviously will be ready to do, and the buyer will not be ready to do unless the buyer is compensated for it. So it's a market is a closed system, right? There are buyers and sellers. The market has to come to equilibrium. So the equilibrium can only happen when the rate here, right? The 79 cannot be the rate for term settlement. The rate has to be adjusted lower, right? Because the buyer has to be in equilibrium. The seller cannot get a significant any advantage because of this trade, because of the interest rate differential. Therefore, the question is, what do we do? How much is the reduction? So generally, the reduction should be commensurate with the interest rate differential that you are going to see. So what is the interest rate differential? In this example, 5%. So how much is the roughly? So roughly 5%, right, into how many rupees? How many days? For 1 day, right? So 5% by 365, that is the 1 day interest on 79 rupees roughly I'm losing. So it comes to roughly around 1 paisa. In this example, 0.01 rupees. So the spot rate, if it is 79, the term rate cannot be 79. It has to be 1 paisa lower for people to have the same benefit that they lost out due because of the interest rate gap. So in this example, the actual amount will be 78.99. That 1 paisa reduction in the rate will be there. Similarly, if I want to do the same, take the same example and move it into the 2 days cash settlement rather than tomorrow, obviously another 1 paisa, depending on how the rates are, today's rate or for tomorrow, the dollar rate and the rupee interest rates, that another 1 paisa will be reduced. So the same $1, if I want to settle for today, I have to pay how much? 78.98 only. Similarly, the seller will only get 78.98 only. Right? So this is basically the difference that you will see in the rates between term, cash and spot. Now, the question is, I gave an example here. The example is, I took the interest rate differential. What is the interest rate differential? USD rate and the INR rate, right? I took an example of 1% USD rate and 6% INR rate. So the difference is 5%, and the 5% for 1 day is 5% divided by 365. That interest rate is the amount that I'm going to forego if I want to buy dollars early. So that interest rate on 79 rupees is 5 divided by 365, 5% divided by 365 into 79. That works out to around 1 paisa. That is how markets estimate, right? Now there are some assumptions here, okay? Now there are some assumptions that I'm making here. What is the assumption? That everybody in the market can freely borrow this US dollars and rupees whenever they want, right? And the rate is known to everybody, right? And so on and so forth. Some of these assumptions might not work in every market. They might work very well in euro to dollar, dollar to yen, global markets, extremely high liquidity across the world. Anybody can open accounts anywhere and trade these currencies, right? Interest rate markets are very liquid, freely available. Deposits can be easily obtained in all these global currencies. But for rupee, that's not the case. Rupee, you cannot just go, and anybody can't just go into interbank market and just borrow rupee, right? For 1 day, for 2 days, maximum 2 days, you can do this. So there are some restrictions. But the point I'm trying to make here is the concept of how interest rates are linked to FX rates when it comes to dates other than the spot date. Now, how is it calculated in the market? Well, first of all, the markets don't calculate it. They calculate it roughly. Actually, in Indian market, what happens, I'll tell you. Now, spot rate is 79. Right now, that is a spot rate. That is a traded market. Everybody knows this. Now, every day, the markets, every moment actually, it keeps changing. Depending on, when I say markets, I'm talking about banks. In India, they're banks, right? Different banks are actually the market. Banks, this market is primarily a interest rate, primarily an interbank market. It's a bank market. So, banks then look at their funding costs, look at their dollar and rupees interest rates. What is the rate at which they're able to borrow or lend dollars and rupees in the interbank market for tomorrow and today? Based on how the estimates are, they assess it is going to be 1 paisa or 0.8 paisa or 1.5 paisa or 2 paisa, depending on how the interest rates are daily. And the market then does what? The market quotes, they don't they quote anyway, they quote the spot rate. That is known. The spot rate, 1 rupee against 79. The spot rate is already quoted. Spot rate is there. There is nothing to be done there. It's quoted in the market. Now, in addition to spot rate, they quote how much is the difference between the spot rate and the term rate, spot rate and the cash rate. So they quote the difference between that in the form of paisa. In this example I gave you, this 1 paisa that I calculated was based on 6% and 1% interest rate, right? Similarly, each bank will look at its own funding cost and estimate how much is the difference between my spot rate and the term rate and the cash rate going to be. And that is what they will start quoting in the market. So that rate is quoted like this. It is quoted like this. Cash term, right? It is quoted like this. Cash term is 1 paisa, or 1 paisa meaning 0.01 rupees. Similarly, term spot is quoted again as 1 paisa, as 0.01 rupees. It is actually quoted in the market because banks, there are so many banks in the market. Each bank will have its own funding costs. So equilibrium will come, and finally they quote this particular rate every day morning, starts quoting. This is called, what is this 1 paisa, by the way? The cash term rate is, instead of term settlement, that is T+1 settlement, if I want to settle today itself, what is the difference? The difference is 1 paisa. Similarly, term spot meaning, instead of spot date, if I want to settle it today itself, that is the difference between spot rate and the term rate, that is quoted as term spot. Right? These two are quoted in the market, directly quoted. Like you have spot rate quoted in the screen, you also have a term rate, a term spot, cash term quoted in the market. So if you just simply go to the market, you will see these 3 rates available to you. Now, how are these 3 rates arrived at? Spot rate is arrived at by simply demand supply. Trading is happening in the market. People are quoting bid offers rates to buy and sell, and the equilibrium rate is what you see at any point in time, like any other market. That's the spot rate. Cash term and term spot are also markets traded where banks trade at the difference between the two based on the interest rate gaps that they are seeing and based on their funding needs. If they want more dollars today than tomorrow, right? Versus more dollars today, tomorrow versus day after tomorrow, spot rate. Depending on how their funding positions are, they trade in this market and generate the cash flows. And if you as a user go to a market, you want, for some reason, you want dollars today itself instead of 2 days later, you can actually get that rate in the market. How do you get that rate? By looking at the spot rate 79 and also by looking at the cash term and the term spot rates, you can actually derive how much is my cash rate. That means cash to spot will be how much? Cash to spot will be simply addition of these two rates, right? Because 1 paisa is spot to term and 1 paisa is term to today or today cash. So 2 paisa is basically the difference between 0.02 rupees will be the rate. So if you want to buy dollars today or sell dollars today, the difference here is 79 minus 2 paisa. That is what is quoted in the market. It's called cash spot. Now, there are some small intricacies, something you have to be aware of. Obviously, these quotes that you are seeing in the market, 2 paisa, 1 paisa, are all quoted based on the interest rates. How is my overnight interest rate? How is my 2-day interest rate looking like in rupees and dollars, and based on which these quotes are arrived at. So, by definition, if the interest rates change, these quotes also will change, right? That is what you have to be aware of. How, for example, during quarter ends, right? Quarter end meaning June end, September end, December end, March end, right? There are some regulatory pressures. That means RBI wants banks to keep some X amount of funds in the RBI as reserves. There are some regulatory requirements. Now, those we will discuss much later when we talk about CRR and so on and so forth. Now, in such a case, what will happen is the rates are changing. Right now, these rates will change quarter ends, and especially financial year end, these rates become more generally higher. Now, because of that, the cash spot, this cash term, these rates actually higher during the quarter ends and more importantly during the financial year end, right? That is something which you have to be aware of. Now, first of all, one more thing you have to be aware of here is, now who are these people who are quoting these rates? They're banks, right? They're not some, you and me, they're banks. So these rates that they are looking at are the rates in the interbank market where banks are borrowing and lending with each other. For example, in India, I'm talking about in India, obviously globally, these rates are called depo rates, right? These interest rates I'm talking about here, they are called, the terminology uses depo rates. Depo rates is the interbank deposit lending rates. They are called depo rates, like euro-dollar depo rate, euro depo rate, dollar depo rate. Right? Depo rates are basically, for each tenor, there are rates available in the interbank market. So if you want, for example, a State Bank of India wants to borrow dollars or place a dollar deposit, then a JP Morgan will quote a particular rate for overnight, 1-day rate, for 2 days rate. How much is the rate, right? Typically, these rates are linked to, because they're very short term in nature. I'm talking about cash term, cash spot, right? So they're very just 1-day, 2-day rates. Of course, these rates are available for longer tenors also, right? 1 month, 2 months, 3 months, 6 months, they're available. But here we're discussing only these overnight and 1-day, 2-day rates, right? These are available in the market. Like JP Morgan will quote the depo rate. And generally these rates they're very close to the central bank or the US Federal Reserve rates, right? Or similarly RBI's overnight repo rate, right? They're very close to that typically because it's overnight, right? It's not, RBI also does monetary policy through overnight rates like a repo rate, reverse repo rate that you have discussed in the monetary policy, right? So these rates are very close to that, but they're interbank market. So for dollars, there are depo rates available in the market, right? Primarily for, that's a terminology used. For rupee though, for INR rate, right? For interest rate for INR, what is this rate? Now this rates for INR is basically what? In India, basically, banks borrow and lend to each other on a regular basis. It's not, it's not like bank lending to you as a user or a company, right? Bank, SBI borrowing or lending to Bank of Baroda, SBI doing a trade with ICICI, right? Banks actually borrow and lend to each other on a regular basis. And generally, in India, unlike other markets, like in global, as I said, these depot markets are available for like 1 day, 2 days, then 1 month, right? 3 months, 6 months, 9 months, and 1 year. Up to 1 year, at least, they are available, right? These depot markets are available in other currencies like dollar and so on. But for INR rates, INR, this market where banks can borrow and lend to each other, they are available for very, very short periods. They're not available for long tenors, like 1 month, 3 months, 6 months, they're not available. But at least for 1 day, 2 days, they're available. And that money is called call money market. Call money, right? Call money is basically the money on call in a way. So call money market is an interbank market where banks can borrow on for overnight rate, or for maybe for 2 days they do rates. So these markets rates are called call money rates, right? Call money. These call money rates are available throughout the day. Banks quoted with each other. Now, where do you see this? You need market data systems like Reuters or a Bloomberg to see these rates. But if you want to see sort of a benchmark, like for example, for dollar rates globally, at least up to even now they're there, but there is this rate called LIBOR. LIBOR is, we'll discuss this much more detail when we talk about fixed income markets, but I'm just mentioning it here. LIBOR is London Interbank Offer Rate. This market LIBOR rate is kind of sort of a benchmark, which kind of somebody talks to banks, looks at all the trades that are happening and takes an average and kind of gives a benchmark. And the benchmark reflects the actual rate in the market, right? This is LIBOR rate available in the dollar market. But for rupee, right, the average rate for the day, roughly of all different transactions that are happening, is published by some agencies. It is called MIBOR. MIBOR is actually a Mumbai Interbank Offer Rate, right? MIBOR is basically the benchmark that is used. Now, as I keep saying, the MIBOR is not like exactly matching, right? It's not like the cash term and the cash spot will exactly match the difference between the dollar depot rates and the MIBOR rates, because the MIBOR is just a benchmark to get a sense of what is that for that particular day, what has been on an average, what has been the rate. But the actual transactions will happen based on between two banks, depending on how much they want to quote at what rate and so on and so forth. So there will be variations in rates. So that is the reason why at any point in time, the cash spot and the cash term rates need not be exactly the same. They will keep fluctuating. So they will change like a spot rate. They'll also small differences. 1 paisa instead of 1 paisa, 1.25 paisa can happen, right? 0.9 paisa can happen. So all of this can happen because they're not fixed rates. But the rates that I'm talking about here are the overnight rates. In India, for rupee, it's called the MIBOR or the call money market. For dollar, it's called a depot market, right? So the point that we have to be very aware of here is that there's a logic to all this that I'm talking about. What is the logic? If your spot date is your cutoff. If the spot date is your cutoff, I'm talking about dollar rupee here. If spot date is your cutoff, that means the default rate for spot date is known to you. Let's say 79 in this example. Then for any rate for a date lower than the spot rate, this example, cash rate and the term rate, the dollar in this case, which you want to buy value cash or value term, the dollar rate, understand this, the dollar rate is lower than the spot rate for these dates, right? It is lower. Why is it lower? Because dollar has a lower interest rate, and hence to compensate the buyers of that dollar, instead of spot date, if they're buying earlier than that, then to compensate for the interest rate differential, that currency which has lower interest rate has a lower value, right? That is the point that you have to be very aware of. You don't need to really be very clear on the calculations, because calculations are really not done in the market. It is done by just an estimate, and they start quoting cash term, and after that, depending on their estimate, the bid offers and everything, it happens. But the concept is very important. The concept is a currency with a lower interest rate has a lower value if you want to settle it before the spot date. Why is that? To compensate and to ensure that there is no arbitrage for people who want to arbitrage between the interest rate differential and the rates in the FX market. If the cash term and the term spot did not exist, the seller of the dollar will make free money. Obviously, right? Because seller is generating free money of 5% interest rate gap if there is no compensation for the buyer. Now, what is the summary here? The summary here is low interest rate currency, right? Low interest rate currency has lower rate or lower value when settled earlier than spot date. This is what you have to drill in your mind. Extending the same logic, right? If somebody wants to buy dollars or sell dollars, it doesn't matter, for a future date than the spot date. That means if spot date is T plus 2, what if I want to buy dollars for T plus 30? That means 30 days from today, or 30 days from 60 days from today, 2 months from today, 5 months from today, 10 months from today. So there are markets rates available for dollar to be bought or sold in the future rate, in the future date. By the same logic, low interest rate currency has higher rate when settled or when later than the spot date, which means if I want to buy dollars for a future date, so for example, today is 7th July, so my spot date is, let's say, 8th, 9th and 10th are holidays, so 11th July is my spot date. If I want to buy dollars for future date, let's say 30th of July or 31st of July, obviously the rate that is quoted in the market cannot be 79, which is a spot rate. It has to be higher than spot rate. That is the difference. The settlement is later than the spot rate date, and therefore the rate has to be higher. So what is it that I'm trying to convey here? It is simply that to achieve, I'm writing the statement here, I'll explain it to more detail. To achieve the interest rate parity, meaning interest rate differential, right? The low interest rate currency should trade at a premium for future. What does it mean? It means, in this example, dollar is a low interest rate currency. To prevent any arbitrage in the market, right? To prevent any arbitrage in the market, you need to have the low interest currency trading or quoting at a higher rate or at a premium, as the market calls it. It's a currency is quoting at a premium to the current spot rate. So for 1 month from now, it cannot be 79. Dollar rupee cannot be trading at 79. It has to be 79.20 or whatever the rate is. Now, how those rates are calculated, we'll talk about it later. I mean, when we really discuss forwards and futures and elaborate calculations around how to actually they are priced in the market, we'll come to that at that time. But at least at the introductory level to the FX market, I'm introducing the concept of a forward rate. A forward rate meaning a rate for settlement of dollars at a future point in time. The rate for settlement of dollars before spot date is the cash rate and the term rate. A rate for settlement of dollars beyond the spot date is the forward rate. And that forward rate is basically such that it is higher than the spot rate normally because in example of dollar to rupee, dollar is a low interest rate currency and therefore it should trade at a higher rate to prevent any arbitrage in the market. Arbitrage meaning for people to make free money, to prevent people from making free money. This is what it is. That the rate is premium. That is the next point that you have to be aware of. Now, this premium or discount, in this case premium, came because rupee interest rate is higher than dollar interest rate. Right? Now, again, the question will come. How are these rates quoted? Again, there are nuances here. I will discuss it in much more detail in the future sessions. But as with the cash term that we discussed, there are two interest rates, dollar rate and the rupee rate. And based on the interest rate differential, the markets evolve and start quoting rates for July end, August end, September end, October end for settlements. You get the rates, right, in the market. Now, banks assess the interest rate differentials in general and also the demand supply, and based on estimate, they start quoting these rates. At this moment, at this juncture, you just have to be aware of the fact that there is a market available where dollars and for currencies are traded for future date instead of just the spot date. Now, how are those rates arrived at? It's a much more complicated discussion that we will part to the later sessions. Now, let us now understand this concept in a bit more detail with respect to other currency pairs, so that you are clear as to what is the I'm talking about dollar rupee here, right? But what about other currencies? So to grind this concept well into your minds, you need to understand this with respect to other currencies also, so that you can appreciate this for all the currencies, not just dollar rupee. Now, let us understand the same logic, same thing with euro dollar. Okay, euro to USD. Now, euro to dollar. Now, okay, one more thing I wanted to make clear here before I proceed to other currencies is this. There is a forward market available which quotes the rates for settlement of the currencies for a future date. Okay. Now, does it mean that the market actually expects the rates to be that much in the future? Not really. Well, theoretically, yes. Theoretically, if you go strictly by theory, what happens is, to entice people in the market to buy the low interest rate currency for the future date, rather to sell the low interest currency for future date and buy the high interest currency for the future date, obviously it is loss making proposition because the interest rate cost will be there. To entice the market participants, the currency over a period of time, when everybody wants to do that, for example, take an example, let's say because of the fact that dollar rates are lower than rupee rates, interest rates, nobody will want to actually buy dollars for future because dollar rate is lower, rupee rate is higher. Why would I want to be in dollar deposit when I can be in rupee deposit? Nobody will want to do that for future date. Now, if nobody wants to do that, what does it mean? It means everybody wants to be in rupees than dollars, right? Everybody wants to be in rupees than dollars because rupee rate is higher, which means that everybody for future always at any point in time, I want to be in rupees now, because if I have rupees now instead of dollars, I can put that rupee in a deposit and generate more money. That means in the future, nobody will want to actually want to buy dollars in the future to rupees. Everybody wants to buy dollars to future to rupee today. So in other words, with time, as interest rates, as the interest rate differential exists, everybody wants to buy dollars, rather wants to be in rupees now and not in rupees in the future, right? So therefore, people will slowly want to get out of rupees in the future, but want rupees now because they want to earn the interest now, keep it in the deposit for some time and then take out in the future. Take out the rupees, that means sell the rupees back and buy dollars in the future, not today. So by that theoretical estimate, currency, dollars should rate everybody. There is a demand for dollars in the future, not today. So the future rate for dollars should go up with time, so that this interest rate gap is reflected in the price in the future. But that is a theory, right? But in reality, that's not what it is. In reality, FX rates don't go based on the interest rate differential. There are so many factors: political, market related, monetary policy, the country's economy. There are so many factors influencing FX rates. So this theoretical logic might not hold, right? So the forward rate here that I'm talking about is not an expectation of the future. It is just and only just the estimate of the market of the current interest rate differential, and hence the rate in the market for preventing the arbitrage only. That means this forward rate is at this moment in time. If this forward rate is anything else other than the interest rate differential, then the market participants can arbitrage, right? If there is a market available, that market cannot be different from the interest rate arbitrage. If there's no market available, that's a different story. Then the FX rates will eventually will be expected to reach that same interest rate differential rate by the time the 6 months happen or 3 months happen, the future date happens. But because there's already a market available where people are quoting the rates which are meant to buy or sell for future rates, and which you can lock in today itself, that rate, that market is a forward market available. That rate cannot be anything other than the current interest rate differential. Otherwise, there will be arbitrage in the market. Does it mean that if dollar to rupee, the rate is higher for dollar in the future, that rupee will always be depreciating against dollar, or rather dollar rupee rate will always be higher? No, obviously not. So that is where the trading comes into picture. As of today, if I buy dollars for 79, let's say 79.20 for end of July for my requirement, and on that day the rupee rate turns out to be 78, obviously I have lost money, because as of today the market was quoting 79.20 as a forward rate, not as an expectation of what will the dollar rupee rate be that day. It is just as on today, that is a neutral rate to ensure that there is no arbitrage in the market between dollar rupee interest rate and rupee interest rate and the forward rate. That's it. It is not an expectation. Please keep that in mind. Forward rates are not expectations of the market. They are simply interest rate differential. That is one point you have to be clearly aware of. Then, therefore, the person who buys dollars for the forward in the forward date, for settlement in the forward date, or sells dollars might lose out or gain, depending on what the rate is going to be for a future rate. It is the same logic as a stock trading, except the difference here is the trading here is for generally values settlement today, but the same logic will apply for forward rate also. If you want to buy a contract for settlement 1 month from now, actual settlement will happen at a particular rate, let's say 79.20. That 79.20 is a rate that you're locked in based on today's interest rate differential and whatever the market dynamics are. To current spot rate and interest rate differential, market has quoted your rate. But by the time your settlement will happen that day, the actual market rate could be something else. So you might either lose or gain, right? That is always there. So keep that in mind. Very, very important. Okay. Okay. Now just quickly, same, I will give, you can write it out in the chat window, your answers for it. Let's say euro to dollar. Now spot rate is 1.01. That's the euro to dollar spot rate right now. Now I'm going to tell you that euro interest rate is 0% and dollar interest rate is, let's say, 1%. Now tell me, what will be the cash rate? I mean, I'm not the number. Number is not what I want. I want whether is it lower or higher than the spot rate, the cash rate and the term rate. Is it lower than the spot rate or higher than the spot rate? Then also tell me what will be the forward rate be, assuming the same interest rate, 0% for euro and 1% for dollar. Cash rate and term rate, will they be lower or higher? Now, how do you think about this? Same logic. The currency which is lower interest rate should be trading at a lower value for rates less than the spot rate, and that currency should trade higher than the spot rate for dates beyond the spot date, right? That is the logic we have to use. Now, using that logic, what will be the cash rate, term rate will be obviously lower, right? Why is it lower? Because euro, this is, and one more thing you have to remember, this euro dollar quote that I'm given here is a number of dollars per 1 euro, right? That is the quote. So it is the quote for 1 euro, the value of 1 euro. The value of 1 euro will be lower because euro is at a lower interest rate. Similarly, term rate will also be lower and the forward rate will be obviously higher. Why? Because it's a rate beyond the spot rate, right? Now, take the same logic, let us use it for dollar JPY. Spot rate is right now, let's say 135, let's say. Now, again, I'm giving you the rates here. USD rate is 1%, JPY rate is 0%. Now, in this case, what will be the cash rate, term rate, and let's say forward rate? What will the cash rate be? Lower or higher? Think about it. Cash rate, will it be lower or higher? Same logic. Which is the basically which is the lower interest rate currency here? JPY. And which is the higher interest rate currency? Dollar. So the currency with the higher interest rate will be higher value for dates less than the spot date and will be of a lower value for dates beyond the spot date, right? In this example, dollar is the currency with a higher interest rate, which means dollar will have a lower value for the future. Now, why am I using dollar rate here instead of JPY rate as a basis of making my conclusion? Because the quotation here is dollar to JPY is $1, which is the base currency here is dollar. $1 is how many JPY? So you focus on relatively dollar as the currency, whether it is of higher value or a lower value. In this example, dollar interest rate is higher rate. So to compensate the buyers, the rate on the forward market has to be lower. The dollar yen market, the dollar has to be at a discount, not at a premium. In dollar rupee, the dollar was at a premium in the forward market. Why? Because dollar was a lower interest rate currency compared to rupee. Here, dollar is a higher interest rate currency compared to the JPY, Japanese yen. So cash rate therefore will be higher, term rate will be higher, and the forward rate will be lower. This is how you can estimate based on the depot rates now in the market and so on. How do you actually assess this based on the depot rates? You can estimate where the rates will be for the future dates, right? This is what the market is for forward rates. Now, this forward market is an interbank market. Whatever I'm discussing is interbank. Global banks, it's primarily interbank market. We discussed it last time in the session also. There are other participants and so on. Okay, there's a question. Explain USD JPY again. Okay, think of it like this. Remember that particular sentence. The currency with lower interest rate is at a premium or rather higher value for the future market, Or put differently, the currency with the higher interest rate will be at a lower value in the forward market. Now, what is the currency with the higher rate in this example? Dollar. Dollar will be at a lower value in the future market or the forward market. How much lower? Anyway, that is dependent on the interest rate differential, but it will be lower in value. So the dollar yen quotation is what? What is the value of $1 in the number of yen terms, right? So the value of $1 therefore will be lower in number of yen. The number of yen could be, instead of 135 yen, it could be 134.2 yen or 134.25 yen. It will be lower value in the future market or higher value in the cash and spot and the term market, basically. So the reason why I chose dollar rate being higher or lower is because dollar is a base currency. That is what is quoted. So in the number of terms, number of units of JPY, right? So dollar rate is lower in the future market because dollar interest rate is higher than the JPY interest rate. Exact opposite of rupee. Rupee rate is higher than dollar rate, right? But here JPY actually is lower than dollar. That is the reason why the dollar is said to be at a discount. So what is the convention here? Terminology here, the dollar is at a discount to yen, to dollar, basically meaning what? The dollar yen forward rate is lower than the dollar yen spot rate. That is the convention. That is a terminology you have to be aware of. At a discount, dollar is at a lower rate in the future value, right?